Opening everything up here. Have only 17 people today. Let me just wrap it up very quickly. What we're gonna do today. So, okay, what we're gonna start doing today is start working on a particular financial model, right? So far we have been analyzing issues regarding revenues and costs from a top-down and bottom-up perspective, right? What we are going to drill today is into a balance sheet format, an income statement format, and drill into a couple of the elements that are usually present in these financial statements. What I'm going to try to do is convey a high-level analysis, this time a high-level analysis on some of these issues, right? So we're going to touch base on depreciation, capex. I'm not going to talk about debt, right? And then what we're going to do in the following classes is we're going to incorporate these, right, as part of our normal analysis, and we're going to drill down into depreciation and so on. Today, what I want to focus is in working capital, right? And I want you to fully understand that and how that flows from your income statement to your balance sheet and how we're going to be normally evaluating this. We're also going to drill into a couple of ratios, right? That's as the syllable goes, right? I was assumed to go through ratios in a different setting, but actually it's helpful to drill them down and start discussing why are they so important, right? And why a DuPont analysis, if you don't know a DuPont analysis, I'm going to explain it. It's really helpful to fully understand how the company is behaving. But first things first, let me just quickly open up the website for teachers. It's a little more cumbersome. I hope you had a chance to review Semana Económica today. I wanted to highlight that. Let me share the screen in a bit. I'm just logging into this. What I wanted to highlight is that today, this week's Semana Económicas editions, right, has a good discussion about M&A and forecasting financial statements, right? It gives you a blueprint of what you should expect to occur, right, in the M&A deals in general. So let me just jump into that over here. Let me quickly get into that. Okay, so let me just share with you the screen very quickly, just in case you didn't have. And you have this access, by the way, through the university, so that's why I'm bringing it up, right? Um, Obviously, the university is closed, but you do have access this through campus group, right? So there's a good discussion about what has happened in 2019 regarding the M&A environment and how several things are popping up in 2020 as part of the normal economic recovery that we are going through, right? And the opportunities that are occurring generally in this arena, right? There's another article here regarding what's going to be potential for buyers, right, in 2021. Given the current economic conditions, obviously you should expect that the prices of several companies have decreased because of the uncertainty of their profit generation, right, of cash flow generation. So even if the company was not affected significantly regarding cash flow, right, there's going to be some issues, some concern regarding the discount rate you're going to be using, right? Remember, when you value a company, you do consider not only the cash flows, right, and the profit that's being generated, but most importantly, what's the risk that we're facing. And the thing here are that there's significant risks that are going on, and that's going to be affecting the value of the companies, and you expect that there are going to be a lot more deals on the distress M&A area, right, in the coming years. Not only 2021, as they are stressing us, right, they're letting us know, but there's going to be a lot more deals occurring, right, in several sectors due to the current situation that we're having. right? So there are significant family business that have been affected by this situation, right? And there's even a discussion, right? Um, Regarding the control of M&As, right? If you, by the way, have been reviewing over the last 2 years, right, the discussion in the news and in Congress regarding control of potential merge of companies, right? There has been several legislation regarding that. There's a law regarding that, and in the COPI has issued um, a rule of procedures, right, regarding how they're going to address that issue and how it's going to be implemented. They actually postponed the effectiveness of that regulation until 2021, right, due to the current economic conditions. They have been focusing on other issues, but it's a good discussion here that they are making regarding how that may be affecting the competition, not only for our companies inside Peru, but also compare regionally, right, to other potential business environments, right? So that means that there are several investment funds or other companies outside Peru that are thinking about investing in our country or buying some companies here, and due to the economic potential or the possibility that they can grow the business, uh, even not only locally, not only nationally in Peru, but also regionally, becoming a hub, and we are going to be losing that possibility if some of these measures are implemented, right? So you know that this type of control is sort of two blades, right? It's something that it can be helpful in regarding how you can protect customers, but also can have a negative effect regarding how you're going to develop potential businesses in the future, right? That's part of the whole deal that we are going through. Okay, so let me. Anybody has any comment on that? You have been looking on these issues before. Okay, apparently nobody. Let me just. Where's the curious? So I need to. I want to share the Blackboard collaborate. Sorry, the Blackboard content that we have, right? Here it is. Right, so I have started to upload several issues. I'm uploading a case right here. Here we are. Let me just increase the zoom on that one, right? So I put a one reading. I'm going to add another one. This is financial statement forecasted by Harvard Business School, right? This case, oh, this is not a case actually. This is a technical note. That's what it's called. Explain the very difficulties regarding financial statement. So let me just quickly put that here in a bit, if I can figure it out. So too many things, too many screens open at the same time, right? So this PDF file, right, that it's showing up right now. Okay, that's awesome. I actually discussed some of the things that we have been talking about, right? Macroeconomic condition, current level of competition, and basically how you're going to be start from the most basic forecast, right? And one of the key issues that you should be checking out, right? We have talked a little bit about this, right? And we're gonna drill into this as we go along today's class, as we work through the model that is already on Blackboard, right? There's an Excel model regarding an agriculture business. Unfortunately, I cannot still, yes, it's only 5 years, I cannot still disclose the name and so on, right? And a couple of the information has been. We're gonna drill into this ratio, that's a spoiler, that we have over here, that we're going to drill into kind of the ratio, how to use that to calculate working capital, right? And I want to highlight that as part of our analysis. And we're not going to discuss the financial forecast right now, but that's something that we're going to be drilling into in the following classes, right? And how we're going to be financing a particular transaction in our companies. So let me share with you. I'm also uploading another case and sending it now regarding how you're going to forecast revenue. I'm going to upload the solution to that case. So that case is not going to be graded, right? It's not a case that I expect you to solve for a grade, but I expect you to solve just to learn how to do it. And it drills into seasonality adjustment, right? So I assume you have seen seasonality adjustment when you took economics 2. Well, that's when I learned about seasonality adjustment, right? So seasonality adjustment, it's a way to consider, right, all the different issues regarding how the revenues of the company or even the profits of the company, right, evolve in different ways, in different periods, quarters, months, or so on, right, based on some seasonal effect, right? That's a typical thing. And you probably have seen about how you're going to consider a 3-month adjustment, right? Um, that is going to help you calculate that, or how do you incorporate some analysis regarding the average for the whole period or for the whole year, right? And we're going to drill into that as part of that case, right? Very quickly as part of that. But for today's scenario, right, what I wanted to show is this model. You do know it's a more complete model than the one that we have been dealing by, right? And this is an annual based model, right, which differs from what we have been analyzing, which was monthly one, right? But we can quickly extrapolate this from a monthly perspective, right? And then calculate it on an annual level. There's nothing complicated on that, as we have seen with a summing function or another index function that we can put together, right? It's going to be very simple. So I want to walk through you through this model, and at some point we're going to start discussing the other elements that are related to this model, right? This is what's going to be for today's lesson, the main objective, and I hope we can finish it on time, right, and drill into this. I urge you or suggest you to review the model, right, during after the class, right, and come up with any questions you may have for next class, or even shoot me an email regarding any issue in the model that you believe. As I mentioned, this was a more complete model that I have tweaked down, right, and try to hide what's the which company it is, right, the one that has been modeled over here. And basically there's some information that it's coming from inside the company regarding forecasts that I have tried to tweak as much as I could as part of this estimation, right? But it's a good understanding of what we have been discussing about bottom-up revenue analysis, right, with a top-down cost analysis as part of this discussion, right? Uh, so any questions so far? Am I speaking too fast? Please let me know. Okay, no cap here. Okay, so let's work it out. So as usual, what always I would suggest is start with an assumption step, right? We haven't talked about it before, but you should have an assumption step as part of your analysis, right? Why? Because that assumption step is going to allow you to tweak the numbers, right? And those numbers are going to be linked, right? Or are going to be used, right, as the link for any other elements in the different sheets that we're going to be having here, right? So even let's say capex from a perspective that I just have it right here, obviously going to flow the cash flow statement. It's obviously going to flow into the balance sheet statement, and you have a single point where you're going to have. In most simple models, right, you obviously have the assumption as part of the whole spreadsheet, right? Um, and that will be very easy. Here, when you start working with more complex models, it's better to be on a different tab, right? A different sheet. One of the things weird with Excel, by the way, is that actually we do have how many rows? In this case, 1 million rows, right? And we only almost always use only 100 to 200 rows, right? Actually, we can build this whole thing up in one sheet, right? You can actually be build every single balance sheet, income statement, but people are not accustomed to that. That's part of the whole, right? I have put some. Oh, this is sorry. This is odd. I'm not using the exchange rate, right? It was just an assumption that I had before, and the numbers are completely wrong right now because that was an old number, right? So you can just figure it out that this was from a couple of years ago. Okay, from a sales perspective, right? What we're going to be drilling into when we are going to be analyzing this, right? It's how we're going to be forecasting sales, revenues, and so on. And what I'm marking here, right, in some particular color are the assumptions that are going to be made, right? How are we going to assume some things regarding the elements? So please bear with me for a minute. So regarding the revenues, right, you obviously realize that this is coming from the income statement, and the income statement is coming from my revenue tab. We're going to drill into that in a minute. Cost of goods sold or cost of sales, right? We're also going to be coming that from that. You're going to observe this cost from project line, right, in this also in the sales side, right? It's because there was an assumption there were going to be some projects. I have eliminated that in this model for simplicity purpose. You actually can incorporate that as part of an additional analysis, as simple as that, right? We also going to have SG&A expenses and realize it's coming from my summary tab, right? So what I have done is some of the issues that are related here in the assumptions tab are coming from each one of these specific tabs where we are going to be trying to estimate them better, right? That's all what is happening. But there's going to be some issues that are assumptions, right? And the typical one that you are going to be observing is the non-operating. Let me increase the font a little bit because it appears very small on my side, right? It's this, just shut the chat, okay. Is this issue regarding non-operating income and expenses, right? And that's actually complicated to estimate, right? Because if you don't know that, right, uh, there's no way to come out. There's going to be some non-operating income or extraordinary expense that you do know. So you try to basically estimate the normal business, right? You go into the revenues, cost of sales, SG&A to come up with your operating profit and EBIT. So for that reason, the non-operating income and expense usually is an average of the information from prior periods, right? Here you have a hit. Sorry, what happened? 1 minute. The internet is playing tricks on me. I'm back. Come on, come on, come on, come on. I'm trying to reconnect. Oh, come on. I'm back. I'm back. No. Okay, so we're back. Sorry about that. And we were so good, it was only 3 sessions without any problem with Blackboard. It had to happen eventually. Right, let me share it back. Okay, here we're back. We're back here. Okay, so what I was meaning is that we try to estimate as part of our typical forecast the normal business, right? Operating business. Extraordinary items or non-operating items like particular provisions, right? Or if you win a lawsuit or if there is a sale of a particular asset and you are capable of obtaining an increase or a profit, I mean, because you're selling it above their historic cost, right, or your the cost that you have in the books, right? That's something that is not usually incorporated as part of your typical forecast in the income statement. So basically, what we assume is either is the numbers very small, you assume it's zero. If it's not small, right, you try to assume historical data, right, to come up with that. In this particular case, I have some inside information, have access to the CFO, right? And we're capable of assuming, okay, oh, here is the typo. Yeah, this should be 2020. So, it should be 2020, 2021, and so on. That's what's happening here. Let me just scroll up down. So we assume that it's going to be the same number, right? Oh, come on. Okay, I'm back. Sorry, guys. It's not. If it happens once again, I'm really initiating my router or using my cell phone and figure it out. Okay, so coming back, what I was meaning is that you can assume that it's going to be the same number, right? Here we had some issues that is going to be what's going to be the employee participation. We talked about that before. Here has been assumed zero. We're going to drill into that when we discuss personal expenses in more detail, right? And here they had an effective tax rate of 15%, right? So the first thing you're going to tell me, hey, wait a minute, in Peru right now it's 29.5, right? And there's several issues that we should be considering regarding this element, right? And in particular, you want to look into the effective tax rate, right? So there's going to be a difference between the marginal tax rate, that's the one where we have been talking all about, right? And right now we know it's 29.5 for companies, right? Um, but the difference here that has been assumed in this case is that the company had some prior losses, right, or prior deferred taxes, right, that they have paid, and it can use, right, to minimize its tax payment. So the effective tax rate on the income that they're going to be generating on the profit before taxes or earning before taxes, it's going to be 15% in this particular case. Even going further, right, there has been several tax exemptions in the agriculture business, in this particular case, a sugarcane producer, right? And that's going to be impacting the number that we're going to be seeing, right? Debt and dividends, I have erased all the information that was supposed to be here. We're going to drill into that in coming sessions and figure out, okay, what's going to be the minimum operating cash balance to come up with a revolver, to come up with a minimum long-term balance, and so on, right? Remember, in the typical debt, you're going to have a current portion of the long-term debt in your balance sheet, in the current liabilities, and also short-term debt, right? That's usually what is called revolver debt because you keep coming that debt every 3 months or 1 year and so on as part of the normal working capital finance, right? And have also eliminated dividends. I have made assumptions here in capex, right? We're not drill into that how that's going to impact depreciation later on in the classes, right? In coming weeks. But what I have assumed here is a maintenance capex that is recorded, right? We're going to drill into where that's coming from. Obviously, that's coming from historical data, right? From the capex that is coming from prior years, right? And I have considered that with discussions with the CFO as part of that estimation. I calculated it as part of sales, right? Because one of the typical way where you estimate capex, right, in general, from a top level perspective, is assume that it's a percentage of sales, right? With the assumption that you are operating at full capacity, right? So if you're going to increase in some way your revenues, you're going to need a lot more capacity in terms of equipment, in terms of PP&E, in terms of land or property or something like that, right? It doesn't necessarily mean that you're building a new factory, right? But you do realize that capex comes as batches, right? It's not that you have a capex that is in a linear relationship with revenue, but in some cases it is easier to estimate capex as a percentage of sales, as we are putting up here, right? And in general, coming up with the depreciation, right? What we are going to be considering here is a percentage of capex, percentage of PP&E growth, right? To figure it out, okay, in general, how much depreciation are we having, right? As part of our normal operations that we're going to have. As you can see, as part of the P&E growth, a very good estimation, right? And you probably are very familiar with the idea coming up with how many years, right? we are assuming here in general, right? And what's occurring here is that there's significant PP&E that have already been fully depreciated. And in this case, it wasn't working that easily, right? 166 years, it's completely out of the blue. But for normal companies, what you are going to be observing is that there is a ratio, right, of PP&E and depreciation, or better said, depreciation over PP&E that is consistent with the number of years that you have as part of PP&E. This company in particular was very old, it's several decades old, and it still uses some of those machinery that is decades old as part of that estimation. We're going to talk back on this in a bit, that this is the working capital side, right? And I'm going to want to drill on this in a second, right? But here are the typical things, right, that we're looking at. Collection period, other accounts receivable period, inventories, accounts payable, right? And we can make an assumption about other accounts payable in general as part of a typical estimation. What is the number? So let me just quickly check on that. Did I make a mistake by tweaking it out? Oh, yeah, I recall this. So this number is that significantly high, right? Because they have an issue with prior labor liabilities, right, from several decades ago, and also with a salute and AFPs, right? So this number is so high because they have these labor liabilities, and that's actually very typical in the sugar production industry, right? If you recall history several decades ago in the 1960s, 1970s, right? What you had was this thing called cooperativas agrarias, right? Where all the workers own the companies. They actually went back and the government saved them, right? The government put money to save them. And then in the 90s, what the government did was give this sugarcane production companies, agricultural business, right, to private hands, right? They either perform auctions or even give them completely to somebody else who want to take care of the business, right? Almost for free, actually, and actually imply that there's a significant liability here, right? That they are planning to pay, but very little over time, right? That's a significant problem that this type of company, agricultural companies, have, especially the old ones. And regarding other asset liabilities, right, I have assumed that they keep constant as part of our typical estimation that we're going to do. Okay. So let me go into how we work on this revenue side, right, of the business, right? It's coming at a price. Oh, sorry, let me increase the font. Nobody's going to be reading anything on that, right? Usually you have, obviously, a first column that has the historical data, right, in order to make a comparison, right, that is going to be helpful in general. What was occurring here in this particular company, it's between, let me just put here a line that's going to be helpful later on, right? To just make it more clear. It was going through a rough time regarding production, right? And then you realize that it recovers over time in its production. So there's a comment? No. So let me close this for a bit. Sorry about that. Okay, so coming back here, what I was mentioning is that there is a change in the production, right? And one of the issues that you're going to observe in some businesses, right, is that there's no seasonality inside a year, right? For example, in retail, obviously there's a peak in sales in Christmas and in Mother's Day, right? Those are the two highest ones. Then you follow it with July with the Peru anniversary, right? The Independence Day, and in fourth place you have Father's Day, right? Regarding that, in terms of sales. In terms of agriculture, there is seasonality regarding years. Why? Because there are seasons in production. You cannot extract or pick up the produce that you have, right, at any point in time. One of the benefits from our country, right, is that it usually have more one harvest season, right? So let's think about blueberries, right, which are so in in the news in the past um, weeks, right? If you have been reading it, there has been a peak in blueberries production, right, and in exports to the United States. So blueberries usually you can harvest them once a year, right? In Peru, it's possible to get even two harvest season or two harvest months in a year. Similar for sugar, right? Not only is productivity on the amount of sugar that you can extract per area cultivated, but also how many times you can extract sugar cane, right, as part of our production. In this case, by the way, is that sugar cane production, as I was saying. And as part of the production, if we drill into the top, that is called production, right? Let me just scroll to the 20. Once again, I miss changing the dates here. 2021. What is that? 2019. This is 2019. Okay. We're going to have some information regarding the. Sorry, that some of that it's in Spanish, right? I actually missed and change that, but I actually think it's more explain. It's better explaining it if it's in Spanish in this particular case, right? So you know that you get the sugar cane, right? You grind it. That's molienda, right? You grind the sugar cane to produce the sugar, right? That we know. We produce the brown sugar, and then you go through a chemical process to produce the white sugar that we are so familiar with, right? But as part of that type of production, right here, I have put how many areas that we have, how many hectares that we have, right? How much is going to be the productivity per sugar cane ton per hectare, right? As part of estimation, and how many sugar cane we're going to be getting, right? As part of that. There's usually decrease, right? A certain amount of grinded sugar that is lost, right? Um, that it appears right over here that is a 4% that is expected to be lost through the production process, right? But you also need to put, by the way, I'm just going to go very quickly over this. Here is a capacity analysis, right? To figure out if we are going to be capable of grinding all this sugar cane, right? Of moliendo toda esta caña de azúcar, right? As part of that. And that's here is estimating how many effective days, how many hours, and what capacity we're going to be getting, right, to grind all this. And it appears obviously that we have been under the 100%, right, and we are going to be moving through a full capacity of that. Having said that, right, you can quickly go over this, right? We're just going to jump into this. The sugar produced through the sugar cane, right? That's part of the total analysis in tons, right? And in bags of 50 kilograms. That's how sugarcane producers usually sell the sugar. But there's also going to be some other byproducts, right, that actually generate profits. One of them is melassa, right, which is used as part of honey uh, brand production, right? And it's added to several sweets, to several dulces que son producidos vendidos en retail, right? And there's also a byproduct called bagazo, right? Bagazo is used to produce cardboard, carton, right? As part of that, and also paper if you go through a more lengthy process, right? And everything that's going to be. You also can get alcohol out of sugar, right? I'm not going to go over the whole detail. Please check it out. I want to prefer to go into the revenue side, but it's basically a very simple analysis of how much bagasse we're gonna get out of the total sugar cane that has been grinded, right? Nothing more than that, actually, in terms of how there's some deterioration or lost production. That's normal as part of the estimation, right? And there was supposed to be some additional agriculture byproducts. There weren't any that were considering. You can also get alcohol, I was saying, right? And we're going to drill, here is a summary, right, that's going to be helpful, coming out with all the information that we have over here from the top. All the productivity of sugar per ton of sugar cane, right? All the productivity that we get of melassa per ton of sugar cane and all balasso. And it's coming up from above, right? To come up with the whole production that we're going to be using as part of our estimation. So these are going to be the numbers that actually care, right? that I'm going to be using on the other side, right, to come up with the revenues. Okay? Let me jump into revenues for that. Any questions so far on what we're doing? Okay. So if there's nothing there, we for that we calculate the production. With that, we use that to come up with the revenue side of the business, right? So we're gonna do price times quantity. We already have the quantity as coming up from that production that we have considered, right? Everything is gonna be brown sugar, right? And we have this company did not consider going out through a lengthy process of transforming brown sugar to white sugar, and everything is being sold in the local economy, right? Nothing is being exported. By the way, there are different prices, obviously, from local uh, to what you're going to see outside, right? And in in general, you observe that there's some sort not necessarily an oligopoly, but the prices are better inside in most of the cases, nationally, that most of the cases for the company, right? Better prices for the company, higher prices for the company, right? There's also an additional revenues coming up from grinding sugarcane for others. That's a minor number, right? And we're going to be considering here all the different prices that we have, right? Let's quickly go over these. I think there's a typo there. Okay, so coming up back here, right, we're going to be considering the prices of sugar, and that's coming up. We mentioned from market analysis, right? There are several industry analyses on what's going to be the future prices of sugar. In particular, if you want to think about not locally, not only sales in Peru, right? There are forecasts for sugar. So there's a stake over here. We're going to be observing prices outside future for sugar if you want to think about in the Chicago commodity exchange that has the different price of sugar for 6 months, 1 year, and so on, right? But what we have over here, right, in general, it's what it's the observed price for brown sugar, right? Um, as part of the typical estimation that we are going to be having in Peru, right? That was the assumption that was made in here in general. And we also put the price that you can get in the outside market, but nothing was assumed to be so outside in general. There's going to be a price for Melasa, right? That it was supposed to be. And I have we have put a price in this estimation of a gas of zero because the company was not capable of selling bagasso, right, to a third party, right? The amount that they had, right, was not high enough to produce enough carbon, right? As part of the total estimation, they opted to just keep the bagasso to develop in the future, right, a plant that can produce carbon, right? One of the issues with the gas is that it can be stored, right? And since this is an agriculture company, they have a significant amount of land that they can use, right, to store the bagasso. The only thing with the bagasso is that it's inflammable, right? You need to keep that cool, that as typical in any agriculture product, right? It can, that is developed from sugar. As you know, sugar can be very flammable as part of the estimation. Revenues is coming from as I was mentioning, from I have coded it. I'm unfortunately have coded by mistake. But well, here correct. It's times q from above, right? And that's the typo that I have coded by mistake. But coming up from that, right, we are calculating times and q to come up with the typical prices as shown as part of the estimation, right? So revenue is easy, right? And I have actually put a summary here, right, to help us come up with a more clear view of the total revenue line compared to the cost line, right? So this summary, right, is also linked to this side of my assumptions that appears over here on the top here of sales forecaster, right? It's coming up from there as part of that, right? A quick summary of the revenue and so on. So it's a bottom-up revenue calculation. And what happened with the cost, right? So the cost is going to have two sides, right? It is usually easy if you are analyzing the company and you have been capable of coming up with the revenue side, you are working with the company, it is very easy to come up with the cost of goods sold, right? You should discuss obviously with the accountant and the CFO what's going to be the different costs that you're going to be having, right? And what we have developed right over here is an analysis, right, on base of the production that we are going to be selling, right, from all these different analyses, what's going to be the cost of goods sold, right? And these variable cost numbers, right, that are coming from before, right, that we have been discussing with managers, right, it's basically an estimation of what's going to be the marginal cost in each one of these different byproducts, right? Typically, you will figure out that here is included all the employee expenses, right? All the issues regarding the supplies in order to generate this, right? And usually you put in here the depreciation, right, of the assets of the equipment that is being used to produce these tons. What we have tried to do here, right, is exclude the depreciation as part of our estimation that we're going to be analyzing that in a bit, right? We try to separate everything related to depreciation in a different tab, right, in order to forecast that correctly. That was part of the whole analysis that was being prepared here, right? So coming back to our analysis, right? You kind of observe here that there is, if we go to line 54, the variable cost that was pre presented by the CFO for each one of the different products, right? These are hard-coded numbers in 20, so it's not copying from above, in 2019, right? These were hard-coded numbers that were presented in 2018. With the production that was sold in that particular year that we know from the historical data, we can come up with the variable cost per unit, right? With this variable cost per unit, you can make some assumptions, right, regarding how that variable cost is going to evolve, right? We discussed last time that in regarding cost, you should try to first consider what is the industry norm, right, if possible, if that information is available, and then incorporate what are the particular idiosyncratic elements of the company, right? In this case, when we analyze this, we consider that the company was not going to be capable of changing its cost production in the coming years, so it assumes to be constant regarding the variable costs and so on, right? In every one of the different business lines or business products that are being generated. With that in mind, with the cost that we have, we know the production, we just calculated that a little bit, and then you obviously you come up with the variable cost forecasted for each one of the different years that we have on top, right? That was part of the normal estimation that we have. So that's a bottom-up approach very easily, and we have done that in the prior sessions, right? That's where I want to focus. Regarding SG&A expenses, right? It has been an estimation based on a more um, top-down approach, right? So regarding SG&A estimation, it was calculated as a percentage of revenues, right? And then we assume some percentage that they expect to be its target, the company's target in the coming years, right? So, for instance, in this particular case, right, the company was on 14.9, right, but they were planning to perform some layoffs, right, as part of their turnaround in 2020, but then get back to the correct track and arrive to a target number of 13.5, right? And that was the idea that was going supposed to be kept as part of the whole business plan that the company had put in place. So that's why it jumped to 16.4, right? And this number that is hard-coded is an estimation calculated on how much, in addition to this number, you were supposed to pay to lay off some people, right? Regarding severance and so on, right? Indemnización por despido. That's basically what's going to be happening. Regarding selling expenses, as part of the turnaround process, what it was observed is that the company was not selling enough goods because there was not enough promotion of these different goods in different markets, right? It was very niche focused in a particular market, locally close to the company. So they will start to work on that as part of the normal production process, right? And it was assumed to be increased from closely to this is 0.027%, right, to a 0.2%, more than 10 times the normal number that it appears over there. Obviously linked to revenue, right? That's the key element that it usually goes when you work it out the SG&A. Coming back, right? So we have already revenues, the cost of goods sold, and the administrative expenses and selling expenses, right? Realize that I have highlighted here that this is excluding depreciation, right? To make it more evident that we are not modeling, let me increase the zoom here, we are not modeling depreciation right now. We are right, that's not part of our whole ordeal. We're gonna model depreciation separately. I suggest to do that. Why? Because depreciation is usually a fixed cost, right? It's usually not going to have to do with the production, right? If you try to calculate the cost, the variable cost, right, compared to the production that you're going to be having. Sorry, I'm jumping from one side to another. This is what I try to figure out. The variable cost per production, you are going to be derailed, right? So it's better to have this variable cost that I have down here, right, without considering any depreciation, right? And if there are fixed costs, right, try not to incorporate depreciation as part of that, as part of the typical estimation that you're going to be having. Let me just quickly jump into my summary once again, right? So we're going to have the summary right over here with the cost of goods sold, right? There's going to be a gross profit, revenues minus cost of goods sold is going to have a gross profit, and that will allow us to figure out what's going to be the gross margin, right? The typical first element of profitability is the gross margin, figure out how are we performing, right, regarding producing these products or selling these products in general, right? Unclear what is happening in these particular companies. The margin was very low, right? It has been high in 2018, right? Of a margin of 37%, right? And you're observing that this margin has dropped significantly. This is, sorry, this is 2016. This is an odd issue, right? Because in 2016, 2017, prices of sugar skyrocketed, right? It was a particular fluke that occurred outside Peru, right? And the company exported significant amount of sugar in these particular years. So that's why gross margin was so high, 37, 37.7. Those are outliers, right? The most thing that has been observed in the industry, right? Some margin flow between 20 and 30 top, right? No more than that. But in this particular forecast, right, when we analyzed the company, there was this possibility to minimize cost, right, the cost of goods sold, and increase the margin going forward, right? The aim of the company was to try to achieve once again the 30% number that was observed in 2016, 2017, right? But we put a cap over there, not going farther than 30 as part of that, right? By the way, in production companies, right? In companies that have a manufacturing facility, you normally observe gross margins, right? That can be in this range, right? That I'm talking about, 30, 40%, right? But in contrast, in retail, you observe a gross margin that is very small, right? You basically try to get profit through volume, right? While in this particular case, in the manufacturing, it's a little bit different. Okay, we are putting here once again in summary the administrative and selling expenses, right? Once again, excluding depreciation to come up with our EBITDA margin. And this is, sorry that I didn't highlight it before, right? But the company, as you can observe, right, started with middle-sized revenue, skyrocket them, and then start dropping, right, in 2019. Cost of goods sold follow through, right? But cost of goods sold as part of revenue continue to be a significant portion in 2019. There's a type over there, let's not mind that. And the administrative expenses, although there were some cuts, they still represent a significant portion. That's why the EBITDA was negative in 2018, 2019, right? This is typical of companies that do not realize that some issue it's an outlier, right? So the company was, oh, sorry, this is what's happening. Should have been correct. Oh, because I moved it to the other side, that's what happened. Okay, so the company was having a normal profit of 10%, 10 million, right, with a 10% EBITDA margin, right? And then it skyrocketed to 35. People get enthusiastic about it, very optimistic, right? Imagine that those prices are going to hold forever, right? But if they only lasted for 2 years and then they are stuck with a cost structure that is not efficient, right? And you heard that in several bubbles, right, that have occurred in the past for several types of companies, technology companies, real estate, and so on, right? So the company was actually having negative EBITDA in 2018, 2019, and it was expected to have still negative EBITDA in 2020, but then it started to change that, right, in 2021. And yes, there's a massive turnaround in 2022 as part of that estimation that is supposed to occur through a turnaround plan, right? Normally, you shouldn't do this significant change, right, from a negative to a positive number that appears so high. But in this particular case, it was because in 2020, the company was planting additional products, right, additional sugar cane that it was expected to receive 2 years after that, right, in 2022, that is going to help them generate additional revenue. That's the explanation that goes behind this significant, drastic change on EBITDA from 2021 to 2022, right? Okay, let's get back to business, right? Obviously, all of this that I'm talking about with you guys has been observed, right, in the same way in the balance sheet and the income statement. So I'm showing you a typical income statements, right? High level once again with revenues, cost of goods sold, SG&A. There may be other operating income. I have put a depreciation and amortization line separately, right? You do realize that that's not the typical way income statements are presented, but it's actually helpful, right? Because it allows us to have, it looks okay right now, I think, the EBITDA number, right, very easily as part of that. We're going to have an interest expense, right? And for the sake of simplicity, I have erased debt from the forecast, right? We're going to drill into that in a bit. I'm assuming that the company cancel off its debt, right? But we're going to discuss that later on. As I mentioned, other non-operating income expenses assume constant in this particular case, just for simplicity purpose, right? Um, they're still going to be having some income tax payments. Let me just click on this one. Sorry. This should be, since I changed the income on there, it should be negative zero, right? That should be happening. L24 and L39. There's a typo. So tweak the model. That's what is happening when you tweak the model. You don't realize there are some issues that shouldn't be happening. Change that. Why am I erasing there the taxes? Because have if you have negative profit, right? If you have earnings before taxes that are negative, you're not supposed to pay taxes, right? And those negative profits, as we're gonna see in future cases, right, in future classes, can be used, right, to compensate future payments, right? SUNAT allows you to use these losses from this particular year 2020 to compensate any earnings you may have in 2021, 2022, 2023, and 2024, 4 years into the future, right? That's part of the current regulations for tax payment, right? So here, there's not going to be any tax payment and so on as part of the typical estimation that we're going to be having, right? Um, Here, by the way, there was a tax payment because the company owed money to the, should be tax recovery as part of that. And okay, so we have here the net income as part of that estimation. You're going to have the typical ratios, right? You should have sales, what's going to be the sales growth, right, to make it more reasonable. Realize that, as I mentioned, it jumped in 2022, right, because there's going to be a lot more harvest, a lot more sugar cane that can be used to increase utilization of the idle capacity, right? But then it comes down to a more reasonable and sensible number, right? 2% growth on sales, it's something that is normal, right? And as we mentioned before, you should try that your sales matches what is going to be the growth in the economy, particularly if we go for the terminal value calculation, right? When we are going to be forecasting not only for 5 years, right, which is the lifespan that I'm assuming here, when we are going to be forecasting for free cash flow to calculate the company's value, right, for the terminal forecasting, you should assume that the growth rate is reasonable, right? In this case, I have assumed that it's close to the inflation rate, right? Given the company's condition. Some people assume 3%, 4%, right? That it can be a lot more sensible in general. Cost as a percentage of sales, right, is another ratio that we should be focusing in, and it obviously is one minus that ratio gives you the gross profit, but it realized that it stabilized right into the future as part of a normal estimation that we're going to be having. And SG&A expense is similar, right? As we have said, that has been calculated on a top-down perspective at 13.7% as part of that, right? And once again, there's an effective tax rate that is coming from the assumptions as part of that estimation. Okay, let me jump into here, right? We've been talking about how the income statement follows into the balance sheet, right? As part of that. So remember, income statement is a flow, right? As part of the normal operations, right? Except when we talk about recurring revenues, right? What we discussed that it's modeled as a stock, right? Because recurring revenue it's more related to the number of users that you have or number of subscribers that you have. Reduce this a little bit to make it more clear, right? So we're going to have a typical balance sheet of the company, right? It should be having a check line, by the way, always a check line, assets equal liabilities plus equity. You're going to actually drill into this a little bit more, right? And it appears obviously zeros here because I have deleted the data and we're going to work into that right now, right? The company did have some intercompany accounts receivables at some point, right? Right now it didn't have, and there wasn't any subsidiaries, right, that are consolidated or eliminated as part of that in the consolidated balance sheet as a whole, right? But it's something that usually is assumed to be constant as part of the estimation. We're going to drill into each one of these lines in a bit, right? PP&E at this point, right? PP&E is coming from depreciation and amortization. We're going to touch based on that. That's basically capex plus depreciation as part of our estimation. And investment, as we're going to see, is going to be constant from others. Okay, so let me stop on that and jump onto the typical things that you should include right into your balance sheet, into your working capital. By the way, just to tweak that, and given the fact that, so who knows the definition of working capital from a financial perspective or from accounting perspective? But let me know which perspective are you thinking about. Okay, so the first one, and that's the accounting perspective, and thanks, Renato, it's current assets minus current liabilities, right? And it has to do with the quick ratio, right? You are familiar with the quick ratio, the creative ratio, you want to think about it, right? Something about it. It's a, you always mix it up the names, but current ratio seems fine. This is from accounting perspective, right? So you took these current assets, right? The ones that appear over here, that are short term, right? And you pick it up the current liabilities that appear right over here, right? Obviously, one key element that needs to be think about is the short-term debt or the short-term portion or the current portion of long-term debt, better said, right? That's not going into current liabilities, right? You're thinking about when you talk about current liabilities, you think about accounts payable, right? Taxes payable, right? Something that may be affecting normal operations of the company. But that's from accounting perspective, right? Let me just highlight that here. Um, or accounting definition, let's say. That's it. What happens when you work with finance, right? And we're going to be talking about working capital, right? Is that you do not take into consideration the cash, right? Why? Because working capital, when we are going to be analyzing free cash flow analysis, right, to come up with the cash, incorporates the net working capital as part of the typical estimation, right? This is called working capital or sometimes net working capital, better said that, right? Because you are netting assets and liabilities. Let me move this a little bit to the right, right? Working capital net, what is going to be happening is it's current assets, right? Minus cash, minus current liabilities. Why? Because when we work out in finance, right, you are trying to estimate the cash flow, right? And if you incorporate the cash as part of the working capital, it actually generates a circular reference as part of a typical estimation we're going to have. By the way, these numbers, as you're going to be seeing, is a plug that is being affected by what we have here as sales, right? Coming back here, right? So working capital net, what actually is, let me just go back here, right? Accounts receivable, type of account receivable, right? That is coming up to the business, that is usual to the business, right? If it's a non-recurring account receivable, obviously you shouldn't take that into account, plus inventory, our typical inventory, right? That we're going to be having, right? Plus, if you think about prepaid expenses, right? You want to pick it up right there. Minus what you are going to be having here on the other side, it's accounts payable, right? And accounts payable, I talk about any type of accounts payable. By the way, we are thinking of, let me just put here, but to make it more clear, we are talking about here employee payable, right? Salaries payable, taxes payable, right? Any type of that. And um, if you want to think about it here, revenues. And are short term, right? We're talking about current. Just put it here. Prepaid expenses less than 1 year, right? I'm gonna save this also on Blackboard, by the way, just to make more clear for everybody, right? Less than 1 year. But they're gonna be deferred revenues that are greater than 1 year, right? But so realize that I'm picking some elements, right, when we're going to be talking about capital net or net working capital from this point in finance, right, in the forecasting arena. Once again, we're not picking cash, right, because it becomes a circular reference because working capital is going to help us calculate cash, right? You're going to realize that when we're going to be working on this, that's the working capital. It's going to be affecting the cash number, right, which is coming out from our free cash flow elements, right? Okay, we're still okay on time. Okay, so let me work it out. So jumping from one page to another. This is coming from the working capital tab, right? So there's a working capital tab. I'm sorry if I didn't explain each one. We have a balance sheet, we have an income statement, we have a cash flow, we have a ratio analysis, very simple, but we're going to drill a little bit more into that with duple analysis. We have an equity tab, right, that we are going to analyze even further later on when we talk about financing. We're going to have a working capital schedule. This is where we're going to be working on right now. We have an others and we have a debt, interest, and a depreciation. Once again, this is a top-down perspective, right, as a percentage, right? What we want to do in, and it appears in the syllabus, is that there's going to be a particular session to come up with a depreciation schedule, right? That's when I want to drill even farther as part of our typical estimation. Coming back here, right? So we're going to be drilling into the working capital arena, as I was saying, right? So the working capital, how do we estimate working capital? I mean, commercial accounts, inventory, and so on, right? Intercompanies are zero, are going to continue to be zero as part of our typical estimation, right? So what we are going to be doing here, right? It's considered the typical ratio. This appears very small. Sorry about that. Let's resize. There we go. Yeah, you can read that. Just let me know if it's too big. Screen appears huge. Okay, so here we're going to be having, as I mentioned, the revenues, the cost, the typical historical data that is coming from our balance sheet with all the typical information that you're familiar with, right? Um, this is non-cash current liabilities. We're going to be talking about here net working capital that we have. Net working capital can be positive, can be negative, right? Do not mind about that in general. Here we have a massive jump in other accounts payable because the company had to recognize that payment to a salute, right, and to the FFS as short term, but they renegotiate that to make it long term, right? There's no matter on that. From remember your cash flow statement, right? What you do care about to generate cash, right, and to consider in cash flow for operations, it was the change in cash, in working capital, right? What is the change in accounts receivable? What is the change in inventory? What is the change in accounts payable, right? That's what I had put here, the increase and decrease in working capital. And we're going to drill farther down on this, and we're going to realize that this is critical when you calculate free cash flow, right? If you're familiar with the free cash flow formula, you know that you need the change in the working capital, the increase or decrease in the working capital that appears here. That's why that line appears over there, right? Further down, in order to estimate the accounts receivable, right, what we're going to be using is the collection period in days, right, what that's days of accounts receivable that we're going to be having, right, as a way to correctly estimate, right, what's going to be the commercial account receivable in the future, right? So, by the way, I have defined the cell this area as days, right? For simplicity purpose, we calculate everything on that element. Sometimes the formula that some people are using is 360 instead of 365, right? That's for simplicity purpose to put that there, right? And here comes the tricky thing, right? To figure out if what the correct number to consider and days of accounts receivable for the company, right? And if you are working with the company, obviously you have access to more inside data, right? That will allow you to correctly pinpoint, right? What's going to be the number in the future, what they expect to be collecting from customers, right? But it's clear that there has been an increase, right, from 2018 to 2019 in this particular right, for the company. Well, one of the things that what we discussed with the company here, or you can actually estimate if you want to, is that okay, it can reverse back right to an 80 days number, right, and later on to arrive to a 75 number as a whole. So these are obviously plugs, right, that you can put into the assumption arena, right, as part of the typical estimation to come up with the calculation that we are talking about right now. We just, sorry, frozen on my side. 1 minute. It appears that it's working back. Having some trouble with Excel. Having some trouble with Excel here. So I'm putting the numbers. So we're back. You can hear me well, right? Sorry, I do need an answer. Yes. Okay. Thank you. That's need one. Thank you. Thank you very much. So what I was meaning is this thing that we just froze. Now we're back on time. I'm putting numbers here, right? But by the way, it should be. Oh, there's a question. It should be just be 1 second. It should be right here, right, in the assumptions tab to make it more simple. I have here the assumption that I made before, right? And obviously what it should happen is that here should be linked to that area, right? We're gonna do that later on in a bit, but I'm gonna want to put it here right now. So there's a question, if I can access the commentary chat, definition should be matched to sales coming from different sources, should just use double sales. Oh, okay. So yeah, so it's a very good question, Rodrigo. But it's actually very difficult, right, to have accounts receivable for each particular good, right, and have the revenue for each particular good. So what Rodrigo Guerra is asking is, can I possibly calculate the days of accounts receivable for sugar, right? That, remember the different products that we have, right? We have sugar, we have melaza, we have bagazo, right? And if you think another company that is more complex, you can have different products. And if the ERP, the enterprise system that they have, right, to get the information is capable of giving you the accounts receivable for each one of the different products, and you have the revenue for each one of the different products, yes, I will suggest to come up with the days of accounts receivable for each different product and model this one not as a whole, but for commercial account receivable for sugar, commercial account receivable for melaza, commercial account receivable for bagazo, and so on, if that is possible, right? Normally, you do not have access to that data, even inside the companies, right? It's very difficult for them to figure it out. Why? Because there may be some customer who buys from the three different products, right? So the bill, right, or the invoice, or even the delivery order, right, has the three products merged in one single number, right? That's the difficulty that you're going to be having. If it's possible, awesome. I would suggest to do that. But usually you should go with total sales as a whole. So coming back here, right, I'm going to assume 80, 80, 75, and then we're going to tweak this and put that in assumption, as I was saying, right? Once again, from the intercompany, it's zero, right? If you recall correctly, there weren't any before, right? Um, Other accounts receivable, right, that are related not to commercial, right, collection from particular employees that they lend some money, right, or particular issues not related to the part of commercial, right? It can be 6 days or 2 days. It was assumed to be three as part of this estimation as a whole. Inventory days, right? That's a critical number that you should actually analyze what's the norm in the industry, right? So in this particular case, the company had a significant delay in selling the inventory, right? It actually created a significant deposit and backlog of inventory to be sold, right? And in the coming year, they were capable of diminishing that, right? But you should assume something that was a more sensible number. And we, in this case, I recall it was assumed like 30 as part of the year, and that's coming from industry data, right? Regarding other current assets as part of sales, right? So remember here on the balance sheet tab, right? And I'm doing this in the working capital tab, but it can be considered outside that, right? Other current assets here on this line, right? It has some particular number that is basically not a commercial account receivable, right? Are prepaid expenses in general that are short term, right? And it had a number that is important. And instead of obviously calculated that as a simple ratio, right? What we did here, what I did here is assume that it was supposed to be a percentage of sales, right? Please realize the following. If you are obviously following everything, if you assume the same number that we have over here and keep it constant over time, you implicitly assuming, and it's a percentage of revenue, by the way, you implicitly assuming that it's evolving, right, as a percentage of sales, right? Keeping the same percentage of sales because it's going to be growing at the same rate of sales, right? That's part of the whole deal. And here, yes, we assume the same idea as a percentage of sales to come up with a number. Let me just take this out. My OCD is forcing me to erase those things. Okay. For the commercial accounts payable, something similar, right? You should try to align it to what is the industry standard, what is the normal thing that you should imagine, and also the historical data for the company. So you realize it has been in the range of 60, right? It only happens that in 2019 they were not capable of collecting uh, from the customers, right? No, sorry, this is payable. Sorry, I'm mixing up. They were not capable of paying their suppliers, right? As part of that, as part of the operation that they had. The reason they were not capable of paying their supplier, or they delayed the payment of the supplier from 60 days, which is 2 months, right, to double it to 4 months, was because they were not capable of generating enough cash as part of that deal, right? What they expect to occur is that they should be capable of coming up to the 60 number in the coming year. So let's put that 90, 60 here, and then we go along, right? Intercompany was again 0 as part of that estimation, right? As part of that assumption, right? And the other elements that we're talking about should be thinking about. And okay, days outstanding, also that's other accounts payable, right? It appears to be a high number. It was supposed to keep that as 294 as part of a typical estimation. And I'm going to put other current liabilities and realize that other current asset was a percentage of sales and other current liability is a percentage of cost of goods sold, right? We're going to consider that as a percentage of cost of goods sold and realize we haven't even discussed so far the numbers, right? We're just plugging it here, the assumptions, right, that are coming, that we are making with the company, right, in this particular area, right? As part of that, we are just going to discuss the formulas in a bit, right? Uh, that is flowing on top. Just highlight this a little bit. Okay, everybody gets the idea. So once again, we are here and we are calculating other current liabilities as a percentage of cost of goods sold, right? And in the past, it has been a 9.549. It was assumed to be 9%, and that's a sensitive number, right? So logically, you want to check this into numbers, right? Not just follow it through with this whole number estimation, right? And you want to figure out, okay, where is the how's the actual value in solids, right? Are we making some mistake by assuming that particular number, right? So here on top is the calculation that we had before, right? So from now, um, accounts receivable line, right, we assume that the company was going to be capable of take control from how much money they collect from customers and decreases from 87 to an 80 days of accounts receivable and then to a 75, right? That was the idea that we have here, right? And that translates from the typical formula, right, on a commercial accounts receivable calculation, right? Remember, days is 365, right, to 90 million as a whole, right? So what we are doing here, just in case you are not familiar with the formula, is you multiply the sales, the revenues, times the number of days of accounts receivables and divide by 360, right? To come up with the estimation of accounts receivable you're going to have. So that's the way you're going to be estimating commercial accounts receivable in each one of these different years. And the number seems sensible, right? It grows with the sales, right? But at the same time, it decreases because you are capable of collecting them more, right? as part of our typical estimation that we're going to be having. Any question on there? Okay, so normally I get a typical question that this formula is not the usual formula for accounts receivable, right? So if you recall, the formula for days of accounts receivable is actually coming up from below, right? When we have calculated here days of accounts receivable, we are getting the accounts receivable in the balance sheet, dividing it by sales, right? And multiply that times the number of days, right? What I usually get questioned about it is that the formula that is presented and normally in some textbooks regarding accounts receivable, right, is that you should consider the average, right? So this is in Spanish. Yes, this is in Spanish. So what you should be thinking about is the average between these two, 2018, 2019, divided by the sales of 2018 times this. Right? So I should be getting the 89 number instead of 87 number, right? And the reason for that is the assumption that, or the consideration, better said, it's not an assumption, it's an issue, that the accounts receivable, it's a stock that is observed at the end of the year, right? This is the stock at the end of 2018, so that means that is the stock at the beginning of 2019. So you should use the beginning of 2019 and the end of 2019 as an estimate, right? As a better estimate, the average between two to the accounts receivable days compared to the revenue that is a flow from the beginning of 2019 to the end of 2019, right? To make that consistency. That is an approach that is valid, right? It is correct to use that. If you want, you can transform the formulas to that. But most regular, you will find this other formula is basically consider, okay, what is the stock at the end, right, as part of the typical estimation. And it goes 2 points, right? The first point is that usually you try to consider that formula if you imagine that these numbers are more or less uh, constant, right? It's not being that they are massively changing and swinging from one year to another. And that normally happens in companies, right, that are several years have been operating, right? They have been operating for several years, right? That other approach with the average is more reasonable to use in startups, for instance, right? As part of that estimation. And the other consideration, it depends on availability of data, right? That in order to consider, okay, we're not going to use just the last year because I don't have any other data to analyze this as part of the estimation, right? So given the fact that I'm using this formula with the last uh, day number, right, with the end number of 2019 in order to calculate the days of account receivable, the days of inventory, and the days of accounts payable, that is why we keep the same formula here. We calculate the commercial accounts receivable. I hope I made myself clear regarding that. Okay, so nothing new over here. Is just a typical application of the formula, right, for accounts receivable and other accounts receivable. But for inventory, right, if you recall the formula that we have before, you should not be using revenue, right? You should be using cost of goods sold, right? Because inventory is more related to the cost of goods sold as part of that, right? If the relationship between cost of goods sold and sales is more or less constant, you will observe that some people do calculate, right, inventory as a percentage of revenue, right, or days of inventory using revenue. It's not an incorrect calculation, by the way, right? It just means that the relationship between sales and COGS, right, it's more or less constant. There's no different mismatch between these two elements as part of that regarding uses, elements produced, goods produced, right, or services provided against the sales of those services or sale of those goods, right? So similar here that we're going to be seeing here in commercial accounts payable, right? I'm also going to be applying the same formula, right, that we have been analyzing to the cost of goods sold, right, as part of a typical estimation to come up with the accounts payable as a whole. And the other numbers do appear sensible, do appear reasonable, nothing is out of whack, right? Nothing is a significant different number than the one we have been estimating as a whole. Um, when we calculate this. Realize that net working capital is being calculated right over here with the formula that I mentioned, right? Considering other current assets, other current liabilities, inventory, accounts receivable, and accounts payable as a negative number, obviously, as a whole. And then we calculate the net. So just to make it more clear, I'm gonna copy this into the assumption tab just to make it clear. What would it? Okay, so following. Okay. So once we have populated this side, let me get back to the working capital tab. Once we have populated this side over here, right, it's going to flow into your balance sheet, right? This is going to be flowing into your balance sheet as part of estimation. Do not mind about the cash being negative, right? It's because I erased the debt. That's why the cash is negative, right? It's saying that we need that in order to think to be viable, right? This model to be viable. That's why it's coming up as a negative number. But I want to focus on this. Let me highlight it, right? It's going to be focused on these numbers that are the ones that we have just generated as a whole, right? And similarly, on the liability side, right, we have generated all these numbers as part of that estimation that we just did, right? And that's going to be helping us coming up with the correct estimation as a whole for current assets and current liabilities. Let me take a moment here to just ask anybody if everybody has any question regarding this. Why am I using the last number? Should I be using average? Should I be using information from historical data? Any other question on that end? Okay, so let me just jump now with the model that we have already prepared over here, right, to the ratio analysis, right? I'm going to drive into the ratio analysis. Oh, I'm going to have to tweak something. Let me just think a minute for a second. Um, the easiest way to do this. Give me 1 second. I'm going to So by the way, quickly realize that I have a problem with my balance sheet, right? Because I erased the debt, right? That is actually telling me, hey, this doesn't work at all. If we have this structure and we have a negative cash over here, that is a massively number that it is not correct as part at all, right? Um, this going to work? Let me just quickly tweak something here because I want the ratios to be correct. And fortunately, when I erase this from the debit and interest side, I'm going to highlight it that we need to correct this, by the way, because it's not right what I'm doing, but I'm just doing it to make it more more easy on my side for the ratio analysis to work it out. I realize that that's what's going to be disturbed. Let's just 877. Yes, yeah, I know what's happening. Okay, so let me just know exactly what to do. Don't worry, guys. So I'm going to tweak in a minute, right, just to make it work for our purposes. Our purposes just going to be. Um, what I'm going to be doing is I'm going to be. Sorry. Yes. Make this better. It's going to work now. Right now that I correct over there, this is going to be working at all in all times. Yes, that's better. I didn't need to do what I did before. But I'm going to correct that. We're going to correct that together in a bit, right? It's assuming something for the long-term debt, just to make the balance sheet to be corrected, right? But we're gonna drill into the debt later on. What I wanted to go into is the ratio analysis, right? And we want to discuss that because it is important to go into a depot analysis, right? We just talk about the working capital ratios, which is the typical ratios you're going to be seeing, right? They're actually reflected in the technical note that is posted on Blackboard, right? There's that's from Darden University, right? There's a technical note regarding how you're going to forecast that particular element, and I'm also posting another case, right? And I'm just going to post the solution, and we're going to quickly go over that in the next class. So coming back here, right? What I have in the ratio analysis tab, right, is this calculation that we're going to be having on total revenues, right? And the typical elements that we have already been discussing. Profitability of gross profit, operating profit, EBITDA, net income, right? By the way, operating profit is what we normally call earnings before interest and taxes, right? That's the typical way we try to estimate that as a whole. But you also want to put in place the total assets, right? Total liabilities, total net worth, right? And my current assets not going to be working. Current liabilities without debt, right? To come up with a calculation as a whole, and some has some assumption about long-term debt, right? What I wanted to highlight, right, is first of all to go with the typical profitability ratios, right? These are our typical ones. I'm highlighting here. Right? These are our typical profitability ratios you're going to be familiar with, right? Gross margin, right? Margen bruto, operating margin, margen operativo, EBITDA margin, and net margin, right? And logically, you know that we try to calculate the EBITDA margin because we do realize that depreciation and amortization, the depreciation of fixed assets and amortization of intangible assets, right, is not cash based, right? And EBITDA margin is a better estimation of the profitability that you are generating, right? Than the operating margin as a whole. So you do realize, obviously, for instance, in 2021, right, that there is, let me just calculate the difference, right, very quickly. 5.1, that, right, that is coming out from depreciation, right? 5.1 is making um, this EBITDA margin coming up from a close to zero, right? It's negative 0.59 to a 5.66 negative number, right? That's what we are trying to address over here. But the clear elements that we like to highlight here when we talk about the profitability is, okay, what's gonna be in general what you expect to occur, right? In terms of growth, in terms of operations, in terms of net, right? So you should expect them to be sensible and arrive to a more stable number, right? And that's what we have been trying to model a while ago with the revenues and costs, right? So we are capable of reaching the 28 percentage in gross margin, right? Based on the revenue that we forecasted and the cost that we calculated, right? Operating margin is going to be reaching something more sensible to 10, right? And net income is a more sensible number of 8, right? With all the different expenses. Remember that the net margin is not considering interest expenses, right? We have assumed that it's zero in this simplicity analysis so far, right? It's a company that has no debt at all, right? So what I wanted to highlight over here when we are going to be analyzing this, right, is that you should expect to find reasonable numbers, right? Nothing, obviously, nothing. If you're forecasting and it's becoming more negative, obviously there was a mistake in the calculation, right? But nothing too high, right? You shouldn't be expecting a margin greater than 20, 30%, and so on, right? Except for the administradora privada, the fondos, they do have a net margin that is significantly high. In part, of course, from cost reduction, by the way, it's not from necessarily higher revenues than normal, right? Okay. Well, this is not going to be working. Debt over assets, it appears small over here because I have assumed the company is not getting any debt. In particular, and we're going to be drilling into this in a bit, right? Liabilities over net worth, right? This is debt over equity, right? This is your debt over equity ratio. Or in this case, better said, liabilities over equity ratio, because liabilities considering accounts payable, other accounts payable, right? All the other elements that we have been saying here, deferred revenue and so on. And the clear element, and this is coming from, realize that we are not plugging anything, right? This is coming from the forecasted data, right? Liabilities over equity es obviamente pasivo sobre patrimonio. Liabilities over assets to figure out how much percentage, and current over current liabilities here is negative as a whole when we had this issue with cash, right? Okay, so what I wanted to highlight is what we're going to discuss very quickly is the typical DuPont analysis, right? That you should probably be familiar with, right? You do know the required return on assets, right, number, um, that is the typical one where you do a division with the net income divided by total assets, right? And the other one that is on below that, right, is is return on assets, right? The average number, right? Required return on average um, numbers for the assets, right? And what's the reason for that? It goes with the same idea that we discussed in working capital, right? Assets is a stock, right? But it actually will depend, right? That if something has occurred in the last day of the year, right? You may have a significant increase in assets, right? Let's assume that in the last day of the year, you acquire a significant amount of debt, right? You acquire a significant amount of debt to repay other debt, right? And you decide to take it from BCP to repay some debt in Scotiabank, right? And they give you the money on the 31st of December 2020, right? So you receive that money on the 31st of December 2020, right? You're going to register debt to BCP. You're still going to register the debt to Scotiabank, and obviously you register the cash from receiver the money from BCP, right? Problem being that you have just significantly increased your assets, right, on that date, and that date is the one that you're using for the cut to come up with the financial statements, right? So you are in reality overestimating your total assets, right? And that implies an underestimation of your required return on assets. That's why calculating this other ratio, which is return on average assets, right, is better, right? And it allows to a better estimation, right, of the return that you are getting, considering the different elements that we have over here. Okay, the other element that we have right here is the required return on equity, right? And that's what we're going to start talking about in a bit, right? So the required return on equity, you know, is basically net income, right? F12, right? Divided by total equity, total net worth, right? El patrimonio total. You can also come up with the require, something I keep saying required, sorry, it's the um, force of using that in corporate finance. So it's the return on average equity on the return on equity, the two numbers that we have over here, right? So coming up with that, right, it arrived to a more reasonable number that you're going to be getting out of this particular situation. Realize that the number is kind of low, right, in this particular scenario, and this should be the return that the shareholders are expecting, right? But obviously, you know that a shareholder will probably not be expecting a 2% return, right, on their investment. That's not something that they are aiming for, right? And this is the result of the estimation that we're putting. And we're going to tweak those numbers going forward, right? And try to come up with a better estimation as a whole. But what I wanted to do, finalize, sorry about that, is going up with the DuPont analysis that you probably have seen before, right? But I wanted to highlight the key elements that are present on our typical DuPont analysis, right? As part of that estimation that we are considering as a whole. So in our element that we have here, the ROE, right? What you're going to be having is net income, right, over net worth, utilidad del patrimonio, right? What we are going to be doing that by decomposing this ROE, right, into different elements, right, and it can be extended even into DuPont analysis, that we're going to be analyzing it from three different sources, right? Through this ROE as net income divided by net worth can be estimated in three different ratios, as you know in the DuPont analysis, right? You're going to be having net income divided by revenues or sales, right? It's requiring me to put this, right? That's the fair ratio, and that's going to be multiplied, right, by another ratio that it's going to be, in this case, revenues divided by total assets, right? That is also going to be multiplied by another ratio, which is assets divided by net worth. Okay. So you do realize from the DuPont analysis that we can ask the correct questions, right? And we're going to quickly do the DuPont analysis right down over here because I already have the ratios on top, right? That's very easy in this particular case. I already have the ratios on top. Net income divided by revenues, it is the net margin. Right? Then we have revenues divided by assets. I don't think I have that. Check. That's the inverse of asset turnover ratio, right? No, it's very easy. So total revenues divided by total assets, right? And realize what it's telling you, right? It's how many soles you are generating for each sol. You're generating in revenues, right? You are receiving in revenues for each sol that you have in assets, right? And last but not least, asset divided by net worth, right? Which is a measure of how much leverage you have in the company, right? Total assets divided by total net worth. When it starts high and then it starts dropping as a whole in our estimation, right? So realize that when I talk about leverage, right, I'm not talking only about financial leverage, right? When you think about assets divided by net worth, by the way, just to point it out better, right? You're implicitly considering, I'm going to convert assets divided by net worth, right? into a different formula just by transforming assets in liabilities plus net worth, right? So are, what you can have here, right? It's liabilities divided by net worth, right? Plus one. Let me just put a here. It's going to be the same, right? This is going to be an, a ratio, right? That is refers to how much of the total assets being financed by a liability. But realize what I mentioned is that it's not only financial liabilities here, right? It's not only debt. It's also the accounts payables that you have, right? Or employee payables, tax payable. So you also have with operational financing, right? It has to go with operational leverage, right? It has to deal with the fact that with the issue that your suppliers is giving you 60 days, 90 days to pay them back, your employees are giving you some time to pay them, or the SUNAT or tax authorities giving some time to pay, you are basically leveraging on top of that, right? And clearly what has been happening here that is helping this company, let me just put that below the ROE line, right, that goes up here, just exemplify how we're going to be recovering, right, from a 4.3 positive, 3.5 negative, how we're going to be recovering in our case to a more seasonal number, right, is the fact that we have been capable, right, of not increasing leverage, which is what's happening, maybe happening here, right? This is not increasing, this is actually decreasing, right? But we are, first of all, improving profitability on an income statement side, right? We are better off as managing costs as we generate more revenues. Costs do not increase in the same percentage, right? They don't increase the same amount. So our net income over revenue ratio are rising, right? It's rising over time, right? But also, more importantly, we are capable of turning around and have assets that are not idle, have assets that are not generating any revenue. We are incorporating assets into our balance sheet that are generating more and more revenue over time. That is why the revenue over assets line is increasing, right? That's the explanation from our ROE perspective that we're going to be having, right? More on this is going to be in, not in this case, it's going to be in two weeks as part of that. So let me stop over here and figure out if you have any question what I have been pointed out. Once again, there's a reading that you can review, and I'm going to post another article on top of that later on regarding forecasting techniques, right, from the University of Darden. Uh, Also, I suggest that we discuss at the beginning of the class for you to review, to do a quick review of what we have in Semana Económica this week, right? There's a very good article regarding um, the M&A environment and M&A perspective in 2020 and 2021. So that's a very good alternative on that. There was actually a good chart. I assume I can, yeah, so the only problem with the version that the university has is that it does not have all the charts that appears in M&A, in that M&A article. I think I have the PDF version of that Semana Económica that was kindly shared by a fellow colleague, and I'm gonna post that too for you to take a very good look on the chart that it has all the main M&A transactions that have been occurring in the past year, right? Careful of what is expected to happen, what is cooking right now in terms of deals, right? Um, okay, is there any other question? Okay, so let's wrap it up over here. Thanks again, guys. Have a good day. And I'm going to post that article I mentioned online quickly.